Hi, I'm Jenny Brown and a warm welcome to our weekly buy-to-let market update. I hope everybody is doing really well. It's a really beautiful day today. It's Wednesday, the sun's shining. I think you can probably see it bouncing off the doors behind me. I think we all need a bit of sunshine in our lives at the moment, don't we? So that's really nice to see. So in terms of what we've seen in the last week from lenders, it's been nice and quiet actually. So a couple of things to share with you. First of all, Barclays have made an announcement that for all of their homeowner borrowers, and this is for new borrowers and existing ones as well, they're now allowing their borrowers to let their homes via sharing platforms such as Airbnb. And what they're saying is the borrower can let either the whole property or part of the property, and this is limited to 90 days in any 12 calendar month period, and can be let for no more than 30 consecutive days. So an interesting move. They're not unique in this. There aren't huge numbers of lenders that allow people to offer this facility to their borrowers. But it is, still great to see such a large lender making such a change in real recognition of where, people's kind of aims are and objectives in terms of, generating some extra income from their property. So well done, Barclays. We've also seen the mortgage works reduce their limited company rates. So their 2 and their 5-year fixed rates have come down, but up to 25 basis points. The mortgage works as a lender are very big in the personal owned property end of the market. So they're a really great lender. They're very happy to lend to people with really large portfolios. Their portfolio landlord offering is very competitive. And they have some really nice pieces of lending policy. So for example, no minimum income requirement. They are very flexible on ages. In the limited company space, their offering is slightly more restricted than some of their peers, but it's still a very good one. And so it's been great to see their pricing come down. They bumped their pricing up when things got really busy. So again, as things start to quieten down and the initial rush of applications has started to tail off, the mortgage works are clearly feeling a bit more confident in terms of their ability to service applications. They've dropped their pricing down to drive business in. And on a similar vein, actually, the Skipton have also done something similar, so dropping their rates on buy-to-lets as well. The rates are very good. They're certainly not market leading, but they're definitely competitive. The Skipton is definitely for our landlord who has less than 4 buy-to-let properties, has income away from rental property, and they're looking to lend on fairly straightforward properties, so single houses and flats, no HMOs, that kind of stuff. And they're not lending to limited companies, but great to see them bringing their rates down to bring them more in line with the rest of the market. Now, we've mentioned this before, but it's come back up in the news again, so I thought I'd just come back to it. So in July 2020, the Chancellor Rishi Sunak asked the OTS to carry out a review of capital gains tax to identify opportunities relating to administrative and technical issues, as well as areas where the present rules can distort the behaviour or they don't meet their policy intent. In particular, Sunak asked for a review of its use in the acquisition and disposal of property and the practical operation of principal private residence relief. Now, this has been described as an inevitable tax raid to recoup some of the money spent during the COVID-19 lockdown period. It's been described, the changes, as bad news for investors. Now, into the 2016 budget, there was a drop in capital gains tax, apart from a property where the 18% rate dropped to 10% and the 28% rate dropped to 20%. Now, the first report has found that many features of capital gains tax which can distort behaviour, including its boundary within the income tax and interconnections with inheritance tax. The report said that more closely aligning capital gains tax with income tax rates has the potential to raise a substantial amount of tax for the Exchequer. And what they've gone on to also just state is that a second report will follow early next year, exploring the key technical and administrative issues around capital gains tax. So I don't think it would come as any huge shock to any of us that if one were to increase capital gains tax, it's going to obviously be a big tax raising event for the Exchequer. But it looks like things are certainly moving forwards with that at the moment, so just worth keeping your eyes peeled for more news as it comes up. Also in the last week, major reforms to support housing tenants in England ensure landlords raise standards where needed were announced on the 17th November by Housing Secretary Robert Jenrick. So the Social Housing White Paper, named the Charter for Social Housing Residents, sets out reforms that will speed up the complaints procedure for residents by improving access to the Housing Ombudsman, reducing decision times and ensuring effective resolution. So the Charter will also make landlords more accountable for the services which they deliver, including access to a new information scheme for tenants of housing associations and introducing a set of tenant satisfaction measures that landlords will have to report against. The Social Housing White Paper delivers on the government's manifesto pledge to provide greater redress, better regulation and improve the quality of social housing. Now, this white paper sets out what the government will do to ensure that landlords deliver this change. Most significantly, the government is reforming the Regulator of Social Housing and Housing Ombudsman Service to drive the culture change required, which will be backed by legislation where needed. Now, alongside publishing the white paper, the Housing Secretary also announced a consultation on mandating smoke and carbon monoxide alarms in all rental homes. Now, in case you aren't aware, a white paper is essentially a proposal which will get put forward. But actually reading this and what the kind of requirements are, none of it sounds particularly unreasonable, at least on face value. And so I suspect this is something that will definitely come to fruition in due course. So for those landlords who do have housing association tenants in situ, this is something just to flag up to you and to keep your eye on. Okay, so let's move on to housing market news. So as we know, statistics do take time to compile, and a lot of the data that's floating around at the moment was put together before the second lockdown was announced. However, most of it has continued to suggest the market has plenty of momentum. Now, the latest RICS survey was released on November the 12th, and this was typical of that. Now, what the survey showed is that the big recent shifts have continued. So buyers are still keen to buy and sellers more willing than they were to put properties on the market. The net positive balance for new buyer inquiries in the survey was a strong 46%, and for selling instructions, 32%. What the report did say is that expectations for house price inflation has eased slightly, with a new balance of 22% in September to 13% in the latest survey. Now, as I just mentioned, the survey was carried out before the second lockdown announcement, but the housing market being open during the lockdown is ensuring that the chief economist at RICS is feeling very optimistic about things. Now, moving on from there, the latest Rightmove House Price Index has been released, and what they have said is that the average price of a property coming to market has fallen by 0.5% from last month, as new sellers have joined the rush to sell and beat the March stamp duty deadline. So what they're saying is that there was an initial temporary dip after the new lockdown was announced, but buyer demand was still up by 28% on the same day last year during the 3 days between the announcement and the lockdown, when it was actually unclear as to whether the housing market would be able to remain open. But the first 6 days of lockdown itself saw demand bounce back to being 49% up on last year, and national sales agreed are now up by 50% on October last year. So Rightmove now estimates there's 650,000 sales going through the buying and selling process, 67% more than at the same time in 2019. So definitely the housing market is remaining very busy for now, and the second lockdown hasn't really dampened that, largely owing to the fact it stayed open, which obviously helps. Now, the other piece of house price news we've had is that average house prices in England and Wales increased by 0.9% in October, the lowest monthly increase since prices began to rise in June this year, but still hitting a new record high, and this is according to the latest eServe House Price Index. And I think just to kind of really hone in on that point, what they're saying is the market is still busy, but actually things are starting to slow down. The initial rush of people looking to purchase and make use of the stamp duty holiday is starting to slow down a bit. I am expecting a second rush to come in sort of January next year, just because that's the nature of the beast and what people do. So, but for now, things are certainly slowing down, and that kind of tails back in nicely to what we've been saying about lenders' behaviours in terms of lowering pricing to start driving business back in again. Okay, so coming back to the sort of house price index, what they have said is that house prices rose by 4.4% on an annual basis, with the average house price in England and Wales now sitting at £314,643. Greater London was the region with the highest monthly growth at 2.5%, with Bristol recording the highest annual growth of 8.3%, having been in the third position at 7.5% in August. Merseyside saw the second highest annual growth at 8.2%, followed by Greater London at 7.3%. And lastly for today, some rental news for you. So rental prices are reported as having risen by 7% over the last 5 years in England, according to the international rental marketplace Spot a Home. So figures collected by the marketplace show that the average tenant in England is now paying £843 per month, compared to £788 5 years ago. What they've reported is that on a regional basis, the East Midlands and East of England noticed the greatest average rental increases, up 15% over the same time frame. They've mentioned that London was the only region to note a decline in average rental prices over the last 5 years, which is down 2%. Furthermore, Exeter saw the largest increase in rental prices across England, up 39%, which was followed by Oxford, which noted a 32% uplift. Now, reading some of the commentary that sat around this from Spot a Home, a lady called Nadia Butt was commenting, and she made kind of just a point that I found quite interesting, which I'd just like to share with you. And what she said was that while London remains the most expensive place to rent in the UK, this causes many tenants to automatically assume that this cost has continued to increase over the last few years. And this is simply not the case. When you consider the high cost of renting within the capital is partially offset by the higher wages on offer, and that this wage growth has remained fairly consistent, it means that the London tenants are actually better off now than when compared to 5 years ago. So, I think while obviously if you're letting a property in central London, if you've seen your rental income down over a period of years, that must be very difficult. What I do think will happen is that this more affordable type of rent in London will really help to ensure that the London housing market remains relatively stable. That is everything from me today. Thank you, as always, for joining me and for your time. And don't forget that if you do have any questions, you're very welcome to get in touch. We'd love to hear from you. You can give us a ring, 0345 345 6788, or go to our website, mortgagesforbusiness.co.uk, where there's lots of information around. So look, enjoy the weather today. I hope you'll get out and get some sunshine, some well-needed vitamin D, and I will catch you next week. Take care.